All right, I'm going to show you the fastest way how you can become financially free through real estate investing. And it's not what they tell you to do on Bigger Pockets and talking about residential real estate. It's actually through commercial real estate, things like industrial, warehouse, and flex space. So let me show you the numbers, let me show you the math, and I'll show you how quickly and easy it is to actually get there. So let me pull up a building that I actually just purchased back in September. It's a building in Birmingham, Alabama, 27,552 square feet. Let's just look at this building, right? It's nothing crazy. It's nothing hot. It's right off the highway. Some draw-up doors. There's an actual blind distribution business in this building right now. And you can see they've got a lot of product. They have a lot of inventory and equipment. And basically what it is, it's a triple net lease. And what that just essentially means is that the tenant is in charge of paying all the outgoings. They pay all the expenses. They pay the property taxes. They pay the insurance. And they maintain the building. So let me just show you some of the ratios and the metrics that are important when underwriting real estate so you can go and present your offer to limited partners, but most importantly, banks and lenders. Okay, so again, residential real estate is valued differently than commercial real estate. So when you go and find a cul-de-sac of 10 houses and all of them are going for $200,000 a pop, that 11th house, whether there's granite countertops or you redid the kitchen, it's most likely going to go for $200,000 because it's the value of residential real estate is what's the comps in the area or what the comparable sales are. Well, in commercial real estate, it's almost the opposite. It's actually based upon the value is based upon its net operating income. So if you can increase the net operating income, you increase the value. So one thing if we're looking at here, you can see the intrinsic value, meaning it's real value. If we're going to take the net operating income, we're going to divide it by the market cap rate. Now, of course, the market cap rate can't really be controlled by anybody. It's just what funds, REITs, individuals are wanting to trade a piece of property at. So if we were to use a building of 10% or a valuation of 10%, you can see that a building like this property that I just showed you, this Jefferson space, is going to be valued because this is what the net operating income is right now. It's $132,000 a year in net operating income. Now, that's not including debt service. I have to go service debt to my banker at West Alabama Bank. But if we know that the value at a 10 capitalization rate is $1.3 million, now look what happens. Let's say that I want to turn this thing down to 9%. It increases the value. Or what if the market cap rate was the same and we increase the value to $150,000 or we increase the rents? It increases the value. So what you can end up seeing is that if you actually go out and find a way to get creative to extract more juice and more money out of deals, especially commercial, you increase the rate of return. So if we scroll down a little bit, another important metric in real estate, especially commercial underwriting, is what's called debt service coverage ratio. Now, there's a lot of people out there that say some banks will do all the way down to 1. Some banks won't lend money up to 1.5. What I've discovered is about 1.25, right in the middle there, is about the most common metric that most banks are willing to lend on. So if you have anything over, let's just call this 125,000, and our debt service is $100,000, our debt service ratio is 1.25. If there's anything less than that, most banks aren't willing to negotiate. They're not willing to do the deal on you. But in this case right here, the net operating income is $132,000. My debt service on this building to West Alabama Bank is $73,000, meaning my debt service ratio is 1.8. Meaning there's a lot of lenders that are willing to do that, and that just means there's a little bit of room for error, knowing that my tenants are going to be able to service that debt. And if any other way in between, if I have in a situation where my tenant doesn't, there's still a little bit of margin for error for me to be able to service that debt. So capitalization rate, this is another kind of metric that everyone trades and thinks about as the most important metric in real estate. It's net operating income divided by purchase price. So again, right now I bought this building at bringing in $132,000 a year. I bought it for $1.1 million. The cap rate on this thing essentially just means it's 12%. I bought it at a 12 capitalization rate. Now again, when you include debt on that, where I have to bring less money to the deal, we'll scroll down and I'll show you what the actual cash-on-cash return is. Then we'll actually see that it's a little bit higher than just because the cap rate is essentially someone buying it with cash, and that's what your rate of return on cash is actually going to be. So Rent per square foot is another metric that's important to lenders, and not to mention too to landlords as well, because you can see here this building has 27,552 square feet. My rental income is 132 grand, like I said before, 4.79. So if I can increase this rent per square foot, which we're going to be doing that actually in the next 60 days to 550 a square foot. Like I said earlier, we've increased the rent, means we're going to increase the value, and that means that we're going to be able to either refinance or sell at a much higher purchase price, because at the end of the day, buyers and sellers and what people are willing to trade that property on is based upon the net operating income. So right now, that's just another metric that's important, rent per square foot. Cash flow to equity, another really easy metric. It's your net operating income. You subtract that from your debt service, and that just means your cash flow to equity. What are you actually making? What are you taking home at each and every year? So it's $132,000. We subtract our debt service to West Alabama Bank, and this is what I put in my pocket every single year. And of course, the rent goes up every year 3%, just because I have rent reviews and rent increases in my leases. But most importantly, in the first year, this is what I'm going to be taking home in net profit. Okay. Cash on cash return, this is the hill that I'm willing to die on as the most important metric in commercial real estate, or really any type of investment in general. But it's net cash flow divided by injected equity. So meaning it's $1.1 million. I had to bring $200,000 in a down payment. That's what the equity I injected. I divide that by, or I divide my net cash flow by what I brought to the table. And that's going to equal just under 30% cash on cash. Now, in real estate, you might think, in the stock market, everyone's talking about averaging 7.5%, 8%, and that's pretty sexy and hot. But in real estate, 30% on cash is not really that uncommon. It's a pretty common. Actually, it happens all the time, actually, because when you can borrow money in the stock market, all you have to do is bring 100% equity. Here, you can buy $1 million asset and you only have to bring 20% of it. So you end up being able to leverage yourself up and create a higher cash on cash return. This is another metric that I've found important in my business is bonus depreciation. Now, I won't get into this video about bonus depreciation and cost segregation study, but to sum it all up into one sentence, depreciation is a phantom expense on your taxes. The government incentivizes investors like you and I to go out there and invest in real estate, and they're willing to give you a phantom deduction on your taxes to incentivize you to buy real estate. So bonus depreciation is just a major league deduction. What you can actually do, again, I'm not an accountant. I'm not going to tell you what's right or wrong. But basically, if you go buy $1 million building, multiply that by 0.25, and that's what you're going to be able to take in an actual deduction in the very first year when you purchase a property. So in this case right here, we bought this building for $1.1 million. We subtract the value of the land, which is $56,500, and then we multiply, because land you can't depreciate, doesn't lose value. And then I multiply that by 25%. I could turn this to 20% and it would change things. But 25% based upon the cost segregation study is going to equal about $260,000 in a passive loss, okay? Which I'll get into that. So what this actually does, it creates a potential tax refund, right? I'm in sales. You probably are in sales too. And what actually happens is we have our employers withhold taxes to pay at the end of the year that we actually end up never seeing. But with real estate, if you are a real estate professional, which again, go find an accountant to tell you exactly if you qualify for that. But in this building, I'm bringing $58,572. I subtract my bonus depreciation of what I just lost before, like this right here. And now, if I multiply that by my tax bracket of 40%, I'm actually going to get a refund of almost $81,000 in a tax refund based upon my sales business and my employer withholding that tax. So not only did I didn't ever saw this out of the gate when I was, earning it during the year, but because in Uncle Sam's eyes, I had this massive loss, I overpaid by $80,000, so they're going to give me a refund. That's playing the tax game. That's what's really important. So coming down to my favorite metric, I'm not going to say I created this because it's real, but I kind of came up with the numbers, but it's intrinsic return on injected equity, meaning it's our net cash flow. We add that to our tax refund, and then we divide that by what we actually injected into the deal. So we're bringing $58,000 a year. We get a refund of $80,000, and then we divide that by the $200,000 that we actually injected into the deal. we're actually going to be earning just under 70% return on our money. Now, I could take it a step further and say that $200,000 actually came from a policy loan. I use life insurance as the way I inject capital into deals. And this number actually, no kidding, it actually goes into the tens of thousands % return, because the only interest the only cost that I actually bring to a deal is my cost of borrowing the insurance company's money. I won't get into that today, but at the end of the day, you can see how quickly the rates of return actually jumps up, where someone is out there trying to nickel and dime to make 7 to 8% in the stock market. It's psychotic, and it blows me away when people are talking about that, because these types of returns are not only legit, but they're not uncommon. They happen all the time. We do these types of deals all the time in our CRE collective, and all the investors that I work with. It happens every single day. So I just wanted to go over all these metrics that have been important to me, and especially buying real estate that I've discovered has been the most passive. The deals are larger, the leases are longer, the banks love to lend money on it. I'm telling you, commercial real estate is the greatest asset that is out there, because you don't have to do a whole lot. There's no headaches. You're not dealing with Red Lobster waiters. You're dealing with business owners as your tenants. And so everything is ACH'd out, and you never have any issues collecting rent. I'm telling you, it is the most passive, life-changing thing that you should ever do in your entire life. So if you have interest in learning more about commercial real estate, discovering these metrics, or even if you want this little slideshow, this spreadsheet that I kind of put together, click the link below in my bio to schedule a call to join our CRE collective, where you can invest in these types of deals. We got tons of them. Believe it or not, we got almost 30 members now that are bringing these types of deals to the table that you can, I'm talking invest in tomorrow, versus you having to learn the steps on how to do all this. So again, if you have interest, we'd love to have you. But if not, click the link below in this bio to schedule this call, and I'll see you guys on the other side. Talk soon.